Welcome, everyone, to the ClearVista Financial Monthly Market Update. I'm Mark Trice, founder and lead advisor with ClearVista Financial. Glad you've taken a few moments to join us today to kind of give our perspective of what's happened in the past month and also what we see going forward. This is our November edition, if you will. And as always, we're keeping a close eye on all things going on in the markets and in the economy. We'll walk you through what that means for you, your investments, and et cetera, and hopefully give you a little bit of peace of mind going forward. So today we'll kind of recap the markets for October. We'll give you a little economic update as of this live session and recording. At the same time, the government is still shut down. My wager amongst other financial advisors was that the government will open this evening. We'll see if that comes true because I'm hoping on winning a dollar for that wager. Let's dive in and talk about the markets last month. So markets actually outperformed expectations. When I say outperform, usually the month of the middle of September through the end of October is a very volatile time historically. And sometimes that means the market goes in a downward direction. We didn't see that this month in October. The S&P 500 was up 2.23%. That's great. Anything positive is great. NASDAQ went up even more, even the small cap Russell index, and as well as the long-term treasuries. We think the long-term treasuries have finally found a bottom, and maybe those will continue to grow over time. We've spent the last 3 years having a bond market that's been on the decline, but since the Federal Reserve has started cutting interest rates, we're starting to see a bottom take place there. And then our moderate index, which we measure kind of a balanced portfolio, was up 0.66% in the month. Now, it's interesting, the S&P 500, we're going to talk a little bit more in depth about this a little bit later on, but a lot of the growth that's in the S&P 500 is coming from those companies involved in artificial intelligence. I'll talk about this in just a moment more. But for now, our common disclosure that we have to share with everyone, so take time to read every word here about what indexes are, what they mean, and how you really can't even invest in them. So, with that said, let's talk about our typical seasonality index that we look at. We're coming into that period of time of the year. The fourth quarter usually is a period of declining seasonality. Okay. Meaning that things are less, things are less volatile, less declining volatility index. So that's a good thing. That usually happens towards the end of the year. Maybe we'll have a Santa Claus rally at the end of December. We don't know. But generally, historically, this is a less volatile time of the year than, say, in September. So let's talk a little bit about the economics of our market and our economy. Once again, text questions to 254-282-0495. Okay, the big news here is that the Federal Reserve cut rates by a quarter point this last week, and that brings the target range down to 3.75% to 4% for big banks borrowing from the federal government. And this move came despite limited economic data because of the government shutdown. Nobody was there to really give us all the data on inflation and things like that. They did bring a few people in, but I would suspect that they will revise those numbers sometime as soon as the government opens up. We know that the government shutdown is affecting a lot of people, especially I was just in the Northeast, and a lot of government workers are now going on their second month without a paycheck. And hopefully they'll get those back. But at the same time, it's really influencing a lot of folks to have to make some drastic changes and things. The Fed also announced that they're going to end the balance sheet reduction. The Federal Reserve has a balance sheet that they keep, and it's had a lot of of funds and bonds and things on that balance sheet, mortgage-backed securities, et cetera. And so they're going to stop reducing that. Now that's known as quantitative tightening. And so that's something that's not really seen by us regular folk, but it's something that does affect how much money is in the system. And so there were a few members that pushed for even bigger cuts than a quarter point, but they were kind of overruled. One of the things that Chairman Jerome Powell mentioned was they're kind of driving in a fog. All right. So they don't have a lot of ability to see the future or respond to actual data because it's not coming out. And so that is something that we have to watch out for. I suspect that there will be another rate cut in their December meeting, but a lot of that's going to depend on inflation. Okay. Let's take a look at the Treasury yield for the end of October. Now we're starting to see the correct shape of the curve where the left end of the curve with shorter term bonds is lower than the right hand of the curve, and that is a more normal shape. Not exactly perfect there. We're still seeing short-term yields stay up fairly high, so that's why sometimes you can still find an occasional 4% CD out there. What about inflation? Well, in October, even with the government shutdown, they deemed a few Labor Department employees as essential. And so mainly because they had to come in and figure out what inflation was in October, because some of the Social Security cost of living adjustments, or actually September, excuse me, some of the Social Security cost of living adjustments for next year needed to be calculated. So the way that Social Security does that, they look at September, August, and July inflation rates, and then they use that to calculate a cost of living adjustment on your Social Security check. Those checks have to be run in December so that you get them in January. And so we saw that. I'll have a little update on that in just a moment. But inflation rose at 0.3% in September. That was a little bit lower than the 0.4% expected. And we're still at 3% year over year inflation. Now, President Trump says inflation's going down. Okay, inflation's not going down necessarily, but it's not going up very fast either. We expected this little increase, and we may see a little bit more. I'm going to talk in a moment about the U.S. debt and how all this impacts it. So, over the past 8 months, inflation's been running closer to a 2.5% annual pace, which is much near the Fed's target of 2%. In September, it was really energy prices that really drove most of the increase, while food prices were nearly flat. Okay. Energy prices kept the inflation from falling further, but the housing costs, especially rents, are finally starting to ease. So, these are all interesting things that we keep an eye on. We look at the individual components of the consumer price index, but right now we're not as worried about inflation ticking up too much, unless, there's some things going on in Washington that might cause inflation to go up. Talking more about inflation, housing may offset some of the tariff hikes on goods. So if housing prices are coming down, that may offset some of the tariff increases that are happening. This is on the right-hand side. You can see that services make up the majority of the consumer price index, and that's for things like housing and medical care, et cetera. But that's the biggest component. And even just shelter itself is approximately like 36% weighting on the consumer price index. But the main reason that we're looking at here, inflation's still above that 2% target that the Fed has. Existing home sales were up a little bit in September, 1.5%. They're up 4.1% year over year. And with some regional trends, we saw sales rise in the West, the Northeast, and the South. But in the Midwest, that slipped a little bit. The gains there were really driven by single family homes there. The median price down slightly. The average median or the median price for homes in America is $415,000. That's still up over last year, but it is starting to slow down its growth rate. So that's important for us to think about there. Mortgage rates have come down just a little bit, around 6.3%. And that's the lowest we've seen since 2023. And at the same time, we're starting to see inventory creep up year over year, and that gives buyers more choices. If I had to describe here in Central Texas the housing market, I would describe it as neutral. It's neither a buyer's market nor a seller's market, it's more neutral. And now wage growth is outpacing home price increases for the first time since 2023. Okay. The big challenge that we have with housing is that so many people are hypothetically locked into their lower mortgage rate. I mean, if you've got a 2.5% mortgage, you're really not excited about selling your home and going and getting another mortgage at 6.5%. So a lot of people are just saying, "Hey, I'm going to stay put for now," and they're not moving the houses, so inventory doesn't turn over as much. So it's kind of interesting to watch this. We'll have to see how much further interest rates go down over the coming months to see if it's something that will stimulate the housing market. Okay, let's talk about the budget deficit and the federal debt. We've got $38 trillion as of this writing. $38 trillion in debt, and the core issue isn't revenue, it's spending growth. So for fiscal year 2025, which ended in September, right before the government shut down, the deficit came in at about $1.8 trillion. This just means we added an additional $1.8 trillion to our federal debt. Now, that's slightly smaller than the year before. And it does account for less of our gross domestic product, about 6%. That doesn't sound like a lot, but it's the first meaningful improvement we've had after 2 years of widening deficits. And when we adjust for things like timing quirks, payment shifts, delayed tax collections, or something like that, the real improvement is closer to 150 billion. I mean, we moved it down further. Spending last year mainly rose in Social Security, Medicare, and Medicaid. These are all our mandatory payments. These are things that are non-negotiable as far as Congress is concerned. So revenues to the federal government grew around 8% when adjusted for disaster-related delays and things like that. But it is a small step towards more fiscal responsibility, but not enough. There are really four ways that the federal government can deal with this ever-increasing debt problem. They can raise taxes, not a popular item. And the One Big Beautiful Bill Act that just locked in tax rates where they were the last 7 years is now permanent. And of course, for our clients, you know that permanent means it's written in pencil with a big fat eraser right next to it. It's only until Congress decides to change that. So they can raise taxes. They can cut spending. Haha, this is where you're supposed to laugh because you know that our dear federal government just has a lot of trouble with curbing their spending. We can devalue our currency. Now, this has been going on. We can devalue the currency. The dollar has been falling worldwide and devaluing the dollar. This can present some of its own issues, but that's another way to deal with the debt. And we can also inflate our way out of the debt by having dollars that are essentially worth less because of inflation. We're paying down the debt with less dollars. It's a little complicated, but those are the four ways: raise taxes, cut spending, devalue the dollar around the world, and having more inflation. And I would say that two of these are happening now. So it's interesting to watch. We'll see, but the federal government shutdown is only adding to the debt, even though most people are working. All right, so Why haven't tariffs had a bigger impact? Well, there's a lot of different reasons, but and I want to be able to see the slide here that has some nice little lines in there. You can see here the green line is the announced rate of the tariff, and then the actual rate of what it might be. And then on the right hand side, you see the actual impact tariffs have had on inflation, and you're seeing more of the that depends on what's the how much of that is passed through to the consumer. So tariffs are having an impact, but not as much as we thought. So a couple of key things that happened in the last month. The U.S. and China reached some sort of agreement last week when the details aren't out, but when President Trump met with President I always get his name wrong. The Chinese president, Xi Jinping, I think, is his name. I can't remember. And something else that right now the Supreme Court is hearing oral arguments to see whether or not President Trump has the authority to enact tariffs without approval from Congress. That's going to be really interesting. But regardless of what the Supreme Court decides, tariffs are here to stay. It just is going to cause a little bit more of a calamity if the Supreme Court says no. Then you've got the government who's not working, the Congress. They're still getting paid, by the way, and that might cause some problems. We have to kind of keep an eye on that, watch that. I've already mentioned this as a kind of a complement to another slide that we had. Housing lowering costs may help some of the offset some of the tariffs on goods. And so this is something that's interesting here. Um, this is kind of the breakout of what part of the economy has the impact on the GDP. The majority of it is consumer spending, and consumers still are spending, but not at the same rate. Starting to slow down. Businesses are make up another part. Government 17%. Basically, the forecast that we've seen so far is the GDP over the year of 2025 will probably expand about 1.9%. Okay, much less than the last year, but we're starting to see those things catch up. We got a lot of different incentives that are expiring in January. This is one of the big debates of the healthcare incentives that a lot of it's going to, believe it or not, is going to pay insurance agents commissions, which if you really knew what was going on there, you would say, no, we don't need those incentives. We don't need to pay the insurance agents. We need to come up with something different there. But this is what the Democrats in the Senate, and it's only the Senate, and the Senate, in order for the continuing resolution to pass, the Senate needs to have 60 senators vote in favor of the continuing resolution. Well, as of right now, there are 52 or 53 Republicans and one Democrat that's willing to vote in favor of the continuing resolution. This is just to simply extend for a period of time what's already been approved and what both parties have already approved. And so I think it's going to happen soon because I think that both parties were trying to see how the election on last Tuesday, was impacted by the government shutdown. And sure enough, people are upset about it. So we'll see how that begins to fall out there. But artificial intelligence is really driving what little growth we have. I'm going to look at this chart here. So business spending on AI, data centers, chips, things like that has contributed equally to the U.S. GDP growth for the first time on record versus consumer spending. And in fact, if you remove all the business spending on artificial intelligence, the economic growth would basically be flat. Okay, so that gives you some idea of the influence there. In fact, we were talking about the S&P 500 performance there. If you go back and look, I think the S&P as of the end of October is up about 16% or so. There are 41 companies in the S&P 500 index that are impacting all that artificial intelligence, or they're really in the artificial intelligence game. If you look at the 41 companies, they're up 28% year to date. Okay, follow me? The rest of the 461, 69 companies in the S&P 500 are only up 7%. So artificial intelligence is really driving the growth in the market, the growth in the economy. We'll see if it continues. And some are suspecting that we're in a little bit of a bubble. Will it be the same as it was like in 2000 when the tech bubble burst? I don't know if we're going to have a burst, but there are some lessons to be watched and learned from that. Okay. AI adoption is just accelerating. You can kind of see the rise in spending from these particular companies year over year. And really, that's driving a lot of the growth in the country. Artificial intelligence is here to stay. I would say that we're already starting to see some reductions in employment because of artificial intelligence. Some of the big corporations, I think it's a combination of the economy slowing a little bit and also improvements in productivity that we have to watch out for. Everyone in our office, we're learning everything we can about artificial intelligence and how to use it to operate our business, to serve our clients better. And believe me, there's a lot of businesses that are doing the same. Am I convinced that we're just going to have mass layoffs because of artificial intelligence? No. But I think if you are still in the workforce, I think it's something that you want to start learning about a little bit so that you are prepared for those changes. We've seen consumer spending moderate. The labor market's beginning to weaken a little bit. We don't have the jobs report from September or October yet. We have the ADP reports, which showed this week that jobs were added quite significantly in the month of October. But we'll have to wait until we get the government data numbers here. Well, they're supposed to be tomorrow, but who knows if they're working? I don't know if they're considered or deemed essential, if you will. So it may be a few weeks before we get that data. See, that's what Jerome Powell was talking about. He's operating in a fog. He doesn't have the data to be able to make decisions, and they are very much data dependent. So the impact of government tax refunds, corporate benefits, et cetera, from the One Big Beautiful Act and deregulation are expected to pump more money in the economy. Most of you are aware, if you're over 65, you've got the enhanced senior deduction, which is $6,000 per person, so long as your income's below a certain level. All these things are going to help stimulate the economy. And it may also increase inflation. So we have to watch and see how those things interact together. All right, so Social Security and Medicare. Well, the Social Security benefits are going to go up 2.8% for 2026. That's slightly higher than last year's cost of living adjustment. And it does reflect a little bit of the inflation kind of coming up just a little bit. Average monthly benefit will rise about $56 starting in January. But most folks, even with the increase, many retirees don't feel like it's fully offset higher living costs, right? Because you got some essentials that just keep going up. A survey that AARP did said 72% of people age 50 and up say a 3% raise isn't enough to keep up with living expenses. So anyway, there's lots of things there. Medicare premiums for Part B in 2026 are going to rise. This is probably one of the biggest increases I've seen in a while. They're going to go up $21.50 a month. So if you're in the first tier for Medicare Part B, you'll be paying $206.50 a month. That's going to offset about 38% of that average retiree's cost of living gain for Social Security. And rising medical costs are going to continue to eat into those gains and so forth. The COLA increase is going to feel smaller because once Medicare premiums are deducted and so forth. Now, this is one of the big debates is the Affordable Health Care Act. Medicare didn't really see a lot of changes in terms of coverages and benefits, but you want to make sure you're reviewing that if you are on Medicare now, because we're seeing a lot of the freebies that some plans had go away. But you'll also want to make sure that your drugs are still covered under some of those plans. Always review during open enrollment period that goes through December 7th. You always want to make sure that that you're reviewing that every year. What type of impact is this? So let's just have a quick discussion about that. You want to talk to your advisor if you have not already for a year-end review and talking about those things, see how these changes in the tax law are going to impact you. We're talking to a lot of our clients now about tax planning so that we can help them stay ahead, maybe take advantage of some opportunities with Roth conversions and so forth. But the main thing is, please avoid decisions. I try to stay off of social media, but sometimes I can't help it. And it's amazing the things that are out there that are absolutely false. And people don't even investigate it. They just run with it. They just forward it to all their friends. And I love picking on some of my family members sometimes because I know there's things that are out there that are being forwarded and they're just completely false. And we're letting decisions be made based on emotions, not facts. We got to stop that. Otherwise, you'll make mistakes. If you're worrying about your retirement, there are a number of different options that you can get help in your workplace retirement plan, your 401k, 403b, or 457. Give us a call. We will give you a free consultation. We have a number of different solutions that you can use to manage your 401k at work. No, it is not the target date fund that your company offers. No, it's not the robo-advisor that charges you a fee for off-the-shelf advice that you can do yourself. You need to talk to a professional that will align your goals and your values with the wealth that you're building in your 401k. So give us a call, text us, make sure you understand your options, and we have lots of tools to help you with that. So what does all this mean? Make sure you're checking, your financial plan. It's time. Check with your financial professional, talk to your attorneys, CPAs, always review that. We always encourage you to take action on your financial journey. We're here for you to help you navigate that, whether it's a bull market, bear market, a recession, anything else. You can make it through all these complex times if you have a good plan. If you don't have a financial plan, you need one. Everyone, regardless of your means, needs a financial plan. You can always contact us, folks, at info@clearvistafinancial.com. And you can visit our website. We have lots of videos on there, lots of educational videos. Hope you'll go enjoy those. Like those, subscribe to our YouTube channel. Those are all things that help us get the word out there about ways that you can really maximize and prepare your financial life. Our next market update will be on December the 4th at 10 a.m., same time. And you can always watch a replay of this on our YouTube channel here in about a week. It usually takes us about a week to get that up and approved for you, okay? So, folks, until next time, thank you for listening to ClearVista Financial Perspectives Market Update, and we'll see you next month. Thanks.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.